Dear participants, welcome to Eleving Group's investor call dedicated to the current public bond tap offering. As always, we will start the call with company's presentation, continued by a live Q&A session. We're looking forward to receiving your questions. You can either submit them in writing through the Q&A window or raise your hand and be unmuted after the presentation is over. For your convenience, we are recording the session, and replay will be available shortly after the call. That being said, I'm turning the call over to our hosts, Eleving Group CEO Modestas Sudņus and CFO Mārs Kreits.
Thank you very much for the introduction, and thank you, Nasdaq, for hosting this event. And of course, thanks everyone for joining today's call. Thanks for showing interest in ongoing Eleving Group's bond offering. So today, obviously, we'll tell a little bit more about our offering, what you can expect, what will be the yield, what are the maturities, and all the technical aspects. But we're going to start with telling a little bit more about our business model. We'll present recent results. We'll also tell what to expect from the company in the nearest future. So I suggest to dive into the presentation right away. Let's start with company's overview. So very shortly, who we are. So Eleving Group is a global financial technology company. We have two main product groups. So 2/3 of our business is in secured financing, in used vehicle financing, where we're financing the most mainstream car on the street, or motorcycle in some markets. And 1/3 of our business is in unsecured financing, where we're primarily issuing loans for purposeful purchases, which are typically consumer electronic goods. And our story has started in Baltics already 13 years ago. And up to this day, even though from business side, Baltics does not play such a significant role, but from business development side, it's a very important hub where all our headquarters are located. We have close to 300 employees. And this is where we started developing our IT systems, our know-how. And our business model is based that we control from Baltics quite hands-on all of our 16 markets globally. Such model allowed us to grow quickly, and focus on developing markets, because this is part of our strategy to go into developing markets where with a bigger need for products like ours, where we're really making a difference, where at the same time competition is smaller, and we're able, using our know-how, using our IT systems, we're able to deliver financial products in those markets. But not only that, through our structure, we're able to deliver not only financial products, but also be first in class when it comes to customer service, when it comes to underwriting customers. And such business model worked great for us, and then we're able to demonstrate solid results year after year. And if we move forward, here are the latest figures for Eleving Group. So already mentioned, we are operating in 16 markets. Just a few days ago, we have celebrated 2 billion issued loans milestone, which is very symbolic, but at the same time very significant for our company. And that could not be achieved without quite significant growth. Over the last 8 years, on average, we were growing 25% per year. And last year, we have finished having 372 million net loan portfolio, which is, of course, the engine for revenue generation, which was 270 million for 2024. It brought 90 million euros of EBITDA and resulted in 30 million euros of total net profit. So all of these figures are best in company's history, and they were gradually growing year after year. Together with our financials, we're also investing and putting additional emphasis into our governance. Almost from day one, we're domiciled in Luxembourg, so headquartered in Baltics, but domiciled in Luxembourg. That allowed us to be quite successful in debt capital markets outside Baltics, as Luxembourg is more understandable jurisdiction. At the same time, as of last year, we've also reached another very significant milestone for the company. We became a public company. We've done an IPO. So now we're a listed company in Riga Nasdaq as well as in Frankfurt in both main lists. And of course, operating many years in debt and now equity capital markets, we've been investing in our corporate governance, received multiple awards from Nasdaq. And also worth to mention that already more than 6 years we're supervised and rated by Fitch Rating. If we move forward, so in this slide you can see some of the key milestones of Eleving Group. And since we are raising bonds again, so here we put a little bit additional emphasis on our history in bond raising. So as a company, you can see that our business has started in 2012 and portfolio grew to 372 million euros at the end of last year. So it's clear that for us as a company, part of the business is not only issue loans, but also raise financing. And bond has been one of the main tools how we have accomplished that. We issued our first bond in 2014 in Latvia, when at that time it was very unusual, I would say, transaction and bond market was not that developed. But gradually we were coming back, and then we were also doing euro bonds. So up to this day, we have raised, refinanced, repaid close to 400 million euros of bonds, and then currently we have 200 million euros bonds outstanding in two different tranches, 150 million tranche and then 50 million tranche. And as already mentioned, as of last year, we were already a listed company with close to 200 million valuation, where we have raised 29 million euros, which of course strengthened us as a company. So now let's turn deeper into business. Let's cover our products. So in this slide, I guess the key takeaway is that our portfolio, when it comes to products, is also quite well diversified. We started, you can see like a Mogo brand. So we started with Mogo brand, which is financing the used vehicle, mainstream car on the street. And this is a product which has already 13, we're 13 years in the market with that, and it's close to half of our portfolio. We also have Primero brand, which is more luxurious, newer car financing. On consumer finance side, depending on jurisdiction, we're offering either consumer loans to buy consumer electronic goods or similar purchases, or in some of our African markets, we're actually financing government employees, and the employer is making the monthly payment. So it's quite a good product in its nature. Also, on our secured financing part, we have quite a few products which has a lot of features of services. So main one would be Mogo loans, where we're financing taxi motorcycles in African markets, and taxi there is typically actually a motorcycle, not a car. And while providing this product, we not only finance the motorcycle, but at the same time we give a workplace to an employee, because we allow to use our tax association networks. We provide all the needed gear to work as a taxi driver, taxi or cargo driver, and then we finance things as casco, helmet, and things like that. Also, we have in some of the Baltic markets rent-to-buy product, which is filling similar needs to financing, but that provides ultimate flexibility for the customer. And also, we've made an investment in car sharing business in a sustainable company, Car Guru. So, combination of that, this is where our 372 million portfolio sums up to. So, quite diversified. And then when we talk about diversification, we're very well diversified, not only in our products, but also in our geographies. So 53% of our overall net loan portfolio is in continental Europe, where 1/3 is in Africa, and then 13% is in Caucasus and Uzbekistan. Quite a few markets, most of them are developing. And of course, we acknowledge that, that in developing markets, economies and maybe sometimes political situation might be a bit less stable to, say, European markets. That's why we really believe in this diversification. Our sweet spot per one market is to have 5 to 10% of overall net loan portfolio. And so far, we've been very successful. Most of the markets fit in that category, and we don't have a market on which we would be too dependent, like more than 15%. So such strategy works for us very well. We also want to keep it going forward as it allows to balance overall group's risk profile. And even in turbulent years such as COVID or such as beginning of the war or changing the interest rate environment, it allowed us as a group to have very balanced operations overall and be profitable. Like actually, as a company, as a group, we've been profitable the last 8 years. If we move forward and deep dive a little bit more into our business processes, as to how do we do business. So let's start with issuances, and here again we'll mention the word diversification. So diversified portfolio has been also issued through various sales channels, which we've established over time. Online still plays the most important role for us as a sales channel. Of course, product web pages. We even have our car portals, which are not competing with the main ones, but which adds good source of leads to our business. And also different integrations, different online integrations with our partners. So more than 60% of all the leads comes through online. But offline, nonetheless, still play quite an important role in our business. First of all, like we have 282 branches across all of our 16 markets. So don't get scared. It's not very operationally heavy because often a branch can be just a table in a shopping mall where consumer electronic goods are sold and so on. You know, same time in Estonia, I believe we have only one market, only one branch, while in Albania, which is still like a bit more offline market, we have close to 40 branches. So we are adjusting our business model to particular market needs. And also very important to mention is our dealership partnerships, which we have close to 2,000. So dealer, this is someone who's selling used cars from maybe that company might have 10 cars, maybe 1,000 cars, but we have all of our IT solutions and they are great ambassadors of our business, and then they can send us leads and then get back answer about the customer within a few minutes. So that's a really close collaboration, which allows us to cover full geography of each country without having physical presence ourselves in every single country and in every single city. When it comes to IT systems, what's important that most of the systems are in-house developed and still up to this day maintained. So that, together with our regional structure, because we have 3 very strong and quite independent regions which don't compete for the same resources and which can develop businesses in parallel, allows us not only to launch markets and then to kind of grow our business quickly, but at the same time to always have a very hands-on control of what's happening in each and every single market. Few more words about our technology, and I want to start with those figures on the right corner. So just to understand the scale of the operations. So if we look at 2024, during the whole year, we received a little bit more than 1.8 million of applications. And these were already kind of full applications, not leads with all the information needed to score the customer. And after all the scoring has been done, our conversion rates were, I would say, quite conservative. It was 8.3% on vehicle finance side and 33% on consumer finance side. So first of all, the difference comes because vehicle finance is primarily car financing, so tickets are bigger, entry tickets are bigger. Of course, we need to score the car as well, and with less returning customers because length of the loan are longer, and people are not changing cars that frequently. And the whole process works like that, in initial stage, we're trying to collect as much information about the customer and vehicle as possible. So we're a regulated entity in almost all of our markets, so we have access to all the main official databases like credit bureaus, good, bad credit bureau, income databases, also in markets where in non-EU markets, we have access to a bit wider range of data sources, such as mobile wallets in African markets or mobile phone operators' data. And all of that provides us a lot of data points to score our customer. Same with car. Like once we get the VIN code, we're able to get all the history, what happened with that car, and mix with data which we get from car portals, we're able to provide quite accurate evaluation. And all of that is fed into our IT systems, into our underwriting models. Some of them are run in Microsoft Azure, so we're able to utilize machine learning and different AI tools. But what's most important is that we're not only able to provide answer within minutes or sometimes even seconds, which is a big competitive advantage. And at the same time, it's done without human interaction. So we decrease our employees' mistakes to minimum. And in most of the markets, we're one of a few players who are able to offer this whole package. If we move forward, of course, debt collection is also a very important part of the business for business as ours. And here again, we rely a lot on technology and in-house knowledge. Most of the systems are in-house developed, and we use such things as robot calls, very advanced notification sending systems, GPS tracking for some customers who take leasing and things like that. And also we have in-house teams who does most of the processes. Typically up to legal collection, we do everything in-house. And that allows us to have, I would say, real outstanding results. So a few numbers which I would like to call out. So first of all, mid-collection ratio is quite good, 66%. That means that even if person has financial difficulties, in most of the cases, we're able to recover him or her. In case, of course, in those unfortunate cases where customer defaults and there is like it's a secured loan, then we go into repossession stage, and we're also very quickly get 84% of all the historical of all the vehicles which went into default. Once we do that, we try to sell them. We do it on average in 1.5 months. And all of that allows us to have post-termination recovery ratio of 85%. What does it mean? That at the moment when customer stops paying, from that moment, all the other actions allows us to recover 85% of outstanding principal at that moment, which is really good result. And then afterwards, our CFO will show that in our NPL ratios. So with that, I'm handing it over back to you, Mario.
Thank you, Modestas. Let me continue with the financial highlights. And here you'll notice a very impressive growth over the last 4 years. Specifically, if we start with revenue, you'll see that we have managed to achieve for the last year more than 200 million in total revenue, specifically 270 million euros, which was 15% higher figure than it was in the year 2023. In addition to that, we're especially proud with our improvements in the profitability. And if we start off with EBITDA, so for EBITDA, we managed to achieve 90 million euros for year 2024, which was 16% higher than in the previous year. And lastly, our net profit has improved even more so. And we managed to achieve 29.6 million euros for year 2024, which was more than 30% of improvement compared to the year one year before. In the lower part of the slide, we have 3 financial covenants, which are present currently in both of our Eurobonds. And if we start off with the interest coverage ratio, you'll notice that we are at 2.4 times of interest expenses over EBITDA. This is actually almost 2 times higher figure than the minimum as per Eurobond documentation, which was 1.25. If we look at the net leverage, here we're also at the all-time lowest level, and here the lower, the better from the bondholders' perspective. means we have less leverage, more own capital in the business. So we are at 3.3 times as of the end of December 2024, while the maximum allowed level is 6 times. And then moving on to capitalization ratio, especially following successful IPO, we're at 29.3% of capitalization ratio as of the end of year 2024, which is 2 times higher figure than the minimum level as per the Eurobond documentation. Moving on our balance sheet. So here in the upper left corner of the slide, you can see our asset development over the time, over the last 8 years. So you can see quite an impressive growth when we started in 2017 with slightly more than 100 million in total assets, and now we're nearing 500 million of total assets. If we look at the liabilities, and if you recall previous slides, excuse me. So if you recall previous slides, which Modest was presenting, they were more about diversified business, diversified across portfolio, specifically from geographical perspective as well as product perspective. You can actually see the same or similar diversification in our liabilities approach. Still, the majority of our liabilities are into the Eurobonds, so specifically to our Eurobonds, 150 and 50 million Eurobonds. Both of these bonds were issued at different times, and the 150 million Eurobond is maturing next year in October, while the 50 million Eurobond is maturing in October year 2028. Interestingly enough, both bonds, although issued with different coupon rates, are currently yielding the same return for our bondholders, especially if we look at the secondary trading prices. And both bonds are currently yielding approximately close to or slightly below 10% annually. Both bonds are also listed simultaneously in Riga Stock Exchange as well as in Frankfurt, and they're also Fitch rated with B with a stable outlook. If we look at the other part of our liabilities, so in addition to our Eurobonds, the second largest source of financing for us remains to be Mintos marketplace for loans. This is the largest platform of its kind in continental Europe, and as of the end of December last year, we stood at 60.5 million euros in funds attracted through the platform. In addition to that, we have been also very successful in raising local capital from local lenders, especially in non-euro markets. So such markets as Kenya or Botswana or Namibia in African markets, we have managed to place local notes, local debt instruments amongst local investors, banks. And by doing so, we're not only diversifying away from one single source of capital for us, and not only improving our blended cost of borrowing, but we're also minimizing our exposure towards these non-euro currencies in the markets where we operate. If we move on, and if we now look at the portfolio quality, we can start off by looking at the net loan portfolio for vehicle business. And here, the non-performing loan portion in our net loan portfolio for vehicle business is 6.1% only. And this is also taking into account a quite conservative NPL definition, which is 35 days and more overdue loans. If we look at the consumer business segment, here we have NPLs of less than 5%, namely 4.3%. And here we're using a more conventional NPL definition of 90 plus days overdue. On the right-hand side of the slide, you can see the gross before provisions and net post-provision NPLs over the last 3 years and how they have developed. The key story here is that our NPLs have been relatively stable across the board, even if we look back throughout these last 3 years, which were especially challenging for any consumer globally, specifically taking into account any inflationary pressure. Now, if we look at the outlook, at the business outlook for this year, for year 2025, it is safe to say that you can expect from our business, from our company, to be launching new markets. And especially in our vehicle business segment, we are looking to launch 1 to 2 new markets where we operate. And these markets will be a mix or should be a mix between African and possibly also European region. In addition to that, we aim to maintain our market leading position in every single market where we operate. If we look at the consumer business segment, so here we expect to grow loan portfolio substantially, especially by issuing higher ticket, lower APR products and substantially scaling our loan portfolios in the newly obtained African markets, especially in the Southern African region. If we think about the capital management, so following our promise to our new shareholders post-IPO, we are aiming to nearly double the business in the next 2 to 3 years while maintaining quite a substantially high dividend payout ratio of 50% annually. And of course, for this, we'll need fresh capital, and 29 million euros raised throughout IPO will not be enough, since we need to add more than 100 million euros to our net loan portfolio. That effectively means that we'll be very active participant in European debt capital markets, and this kicks off with a new bond tap offer, which we'll discuss in the later slides. In addition to that, our investors can expect us proactively addressing our 2026 Eurobond, 150 million Eurobond maturity, and we expect to have a tangible refinancing plan in place already as soon as the first half of this year. And lastly, on the governance and sustainability, we are still developing and finishing our ESG strategy for next 5 years while maintaining certain commitments that we have made to our communities in terms of carbon neutrality and emissions. Speaking on ESG, so you can look at our business from 3 angles, same as any other business. And if we start with environment first, so our mission is to finance the mainstream vehicle that drives on everyday streets of the markets where we operate. In Europe, that actually means 9 to 10-year-old vehicles. In our instance, we also try to promote as much as possible, a push towards more sustainable electric or hybrid mobility. And that's why we're offering better terms for those customers who choose electric or hybrid vehicles. In addition to that, we're scaling up our e-motorcycle financing in African business, for which we also have already funding locked in place from IFC. If you look at it from the social aspect, so here we are also educating our potential existing and future customers by implementing or having online tools in place where our customers can proactively check their credit worthiness and actually can get acquainted with the specific terms of the potential loan from our company. And lastly, on the governance front, especially following successful IPO, we now have an independent supervisory board in place, and we have a well-functioning governance framework, which is already yielding tangible results. And those tangible results would be awards for Best Investor Relations from Nasdaq Baltic in year 2023, and also just recently an additional award for Capital Markets Event of the Year in the Baltics for last year. Now, if we look in details on the proposed transaction, so here important to note is that under this transaction, we're tapping or issuing new bonds under the framework of 50 million euro bond. So this is the existing documentation that is already in the place. The technical aspects of the bond do not change, so the ISIN stays the same. The bond will continue to be listed in the Baltic Stock Exchange as well as in Frankfurt Stock Exchange. And this bond we're offering to our investors with a 10% yield to maturity. So that's the 10% return that our investors can expect to receive, provided they will hold the bond until the maturity. This 10% return is being ensured by having already existing in place 13% coupon rate. However, this bond we're issuing with a price of 109%. It is important to note that this price is actually close to or even slightly below the secondary trading price of the bond. So if you look at the secondary trading volumes and the prices in the Nasdaq Baltics or for that matter, also in the Frankfurt Stock Exchange. You'll notice that our bond, since the very first month of the issuance, has been trading consistently above nominal, and for the last year, or even more so, consistently above 110% from the nominal. We're looking to raise the new amount up to 50 million euros. So that in practice, that means the tap volume can be anything between 0 to 50 million. And what's important is that we are raising new capital. So new capital for our business, which will be invested into our high-yielding net loan portfolio. But our balance sheet management actually allows us in a near term to pay down most expensive part of the debt. So that means in a case if we would raise 50 million euros, those 50 million euros would not sit idle on the balance sheet, and we would not just be having liquid assets in our bank accounts and paying high interest rate to our investors. We'll actually would be in a near term paying down the most expensive part of our debt, and we have the ability to partially prepay parts of our debt without any early prepayment penalties. So effectively, any euro raised would be effectively and efficiently put into use. What's important also, we're not, affecting negatively our Eurobond maintenance covenants by raising this new capital, new debt. So the only thing you'll notice here is that the capitalization in a near term might decline slightly. However, it will quickly rebound once we invest in our net loan portfolio and we start earning money from our net loan portfolio. And lastly, it is important to highlight the fact that this is one of the few senior secured and guaranteed bonds in the Baltic market in general. So this is not customary that the companies would actually offer secured and guaranteed bonds. This bond is specifically guaranteed by more than 10 subsidiaries where we operate. You can see those here in the slide with the dotted line. In addition to that, we'll be providing loan portfolio, main bank account, and share pledges of two of our markets in Caucasus region, so Armenia and Georgia. In this slide, so this one is actually an excerpt from bond documentation, so terms and conditions. Here you can see the specific details, the names of the legal companies that are acting as guarantors, the companies that are providing share pledges, and the actual pledge mechanism. As mentioned before, this bond, same as the company, same as the other bond, will remain to be rated by a Fitch rating agency with a B and a stable outlook. Importantly, the remaining maturity for this bond is 3.5 years. So although we issued a 5-year bond back in October 2023, now in March 2025, we have 3.5 years left towards the maturity. The bond is issued under the Luxembourg law with the standard high yield documentation and regulatory framework, which would be Reg S, which is customary in the European high yield markets. And lastly, we have several Baltic and German banks acting as managers for this bond issuance. I strongly suggest our investors to visit our webpage, our company's webpage, as well as our dedicated bond webpage, where you can actually get acquainted with the specific details, how you can subscribe through your main banks, where you bank yourself. And if you are not finding a bank who is able to provide the subscription services, I suggest to look for, let's say, alternatives. And one of the most convenient alternatives is also Mintos platform, which is offering subscription to our bonds, even starting with a 50 euro starting ticket. Think with this slide, I'll hand it over back to you, Modestas.
Thank you, Marius. So this is the last slide of today's presentation. A summary, you could say, the key highlights why to consider investing in our bond. So first of all, you've been hearing today a lot word diversification, and our business is really very well diversified. It's across 16 markets. We're in developing markets, growing economies. At the same time, we do acknowledge that they possess certain risks. So portfolio is very well diversified between the markets. At the same time, also very well diversified between the products, having 2/3 in secured and 1/3 in unsecured lending. And we've been showing consistently that we know how to manage portfolio quality very well, even in tough times such as COVID. Like we managed to maintain strong and I would say low NPL ratios across our product range, which are constantly improving. When it comes to infrastructure, we've been operating and investing in our infrastructure already for 13 years. So we have very well diversified sales channels, both online and offline. Have very well functioning IT systems, which allows us to scale our business, which allows us to have very strong daily oversight of our businesses. And most importantly, we have a team close to 3,000 employees across all of our 16 markets, and our headquarters team with a solid track record, with a proven track record, which knows how to run those markets very effectively. And of course, since we're offering to invest into debt instrument, credit profile is especially important here. First of all, I think everyone should look what the company has achieved in the previous issuances, in the previous reporting periods, and where we stand now as a company. Basically across the board, we have highest ever financial figures. Our equity is all-time highest post IPO. Like our capitalization ratio is close to 30%. We came out after another very successful year, which has been historically most successful and most profitable, where we have earned 30 million euros of net profit. As already mentioned, we're a listed company in 2 prime exchanges, and we've proven that we know how to issue bonds, we know how to refinance bonds, we know how to repay bonds, and then we have already more than 10 years of track record in capital debt markets. And lastly, on top of that, we have an oversight from third party, from Fitch rating agency. So thank you very much. That's it when it comes to slide presentations. I know that there's questions, so I'm handing back to you, Nazda.
Thank you. Let's now start the second part of our call with the Q&A session. Participants, you can submit your question either in writing through the Q&A window or raise your hand and be unmuted. We will start with the questions submitted prior to the call, then prioritize the audio questions and continue with those submitted in writing. The first question that we've received: what's the reason, or for what are you raising the money, and why not green bonds?
As mentioned already before, the primary reason is the growth of our net loan portfolio, and this is the primary use of proceeds. In a near term, we'll put the money raised into efficient use of capital and will pay down the most expensive part of the debt, but ultimately expect to see all the money raised being invested in the net loan portfolio. On the green bond question, here, of course, we have assessed the opportunities to issue green or sustainability-linked bonds. However, we believe, as of the current state of the company, especially given the fact that our green or sustainability mobility products are just starting to take off, and we don't yet have a sizable, let's say, electric or hybrid vehicle loan portfolios that we would raise the bond against. We believe that it is still premature for our company to be issuing or thinking about green or sustainability-linked bonds. However, we do not exclude that opportunity sometime in the future.
Thank you, Mari. Do you consider there is appropriate governance in the group, from underwriting to treasury management and board capability?
Thank you for the question. So first of all, it's worth mentioning that we have invested quite a bit in our corporate governance over last years, preparing for the IPO process. So as of now, the management board is governed by primarily independent supervisory board. We also have non-executive directors in Luxembourg level, and going kind of below in the corporate structure was a lot of different corporate governance levels across key functions, from already mentioned underwriting to say treasury, and then lastly, since we're regulated by mainly central banks across our markets, we also put additional emphasis on our corporate governance. So even on country level, often we have independent supervisory boards and similar structures. So as of now, we believe that we have an appropriate corporate governance structure, which allows not only to manage business transparently, effectively, but at the same time to still be able to make timely and kind of quick decisions.
Thank you. What will be the repurchase price for the new bond issue, which is being sold at €9 above nominal?
Thank you. I guess the question here is more specifically about call options embedded in the bond documentation. So the first call option is in October year 2026 at the price of 101% from nominal, which would be then followed by the second call option in October in year 2027, which from that point onwards would be potentially done at par. But here I also wanted to mention the fact that every time our bond nears the maturity or we are exercising any of our call options, we are always providing a new debt instrument to our existing and future potential investors to invest in. Because as a company, here also I can go back to our promise to our new shareholders through IPO process, we expect to substantially or significantly grow the company. So that means our net loan portfolio should be exceeding 500 million euros in the next 2 to 3 years. So that means we'll be actually always looking for the new capital to be raised. So repeating myself, whenever we would exercise the call option or call the bond prematurely, our investors can be sure to expect a new bond offer to replace the previous one.
Thank you. Which markets where you operate in are considered to be the riskiest, and why?
Thank you. So first of all, I think when we look at every market, there's many different risks which we need to evaluate, from product risk to customer risk to market risk, economic situation, or even foreign exchange risk. But at the same time, also such risk as competition risk. So you can't just carve out only market risk. And if we still think that kind of core risks to address are kind of product risk or like the customer risk and country risk, then here we try to balance those risks together. And if country possesses higher inherent risk due to development stage of a market, due to some political situation, then of course the conditions for the customer to get the financing that they are, let's say, also more conservative, most likely pricing would be higher, entry barriers also would be higher. I could give like a good example and then compare probably least riskiest market, Estonia, to markets, to some African market. If we're issuing the same car financing product, so in Estonia, down payment can be even zero, while average down payment in market as Uganda is 40%. So skin in the game of a customer differs significantly. On top of that, of course, pricing is also way higher in market as Uganda. So we always, if market has a higher market risk and economic risk, then we balance that with more conservative underwriting policies and then product features, and that proved to be a right strategy. And I guess the best test was COVID times, when even though there has been different restrictions and different, let's say, turbulences in different markets, especially in developing markets, such strategy, while managing market risk with product risk, allowed us to still have successful years. So I wouldn't call some particular market, but we always take different market risk into account and we balance it with other risks.
Thank you, Modestas. As I don't see any raised hands, let's continue with the questions submitted in writing. How much will be the net debt EBITDA ratio after the transaction?
I think we can go back a few slides here. So that would be seen here post-transaction in the lower left part of the slide. So that would be 3.5 times. So the increase would be, I would call, insignificant.
Thank you. On the same topic, will all of the proceeds be used for refinancing?
Not all of the proceeds would be used for financing. So here we have assumed that roughly half of the proceeds would be used for refinancing existing liabilities. Other would be put into the net loan portfolio in the short term. Again, ultimately, at the end of the day, all the proceeds over the longer period of time would be invested in the net loan portfolio.
Thank you. Is there any plan to increase the credit rating for the company and also for future issues? Paying 10% is at least 3 times more than what's the average yield in the market for corporate investment grade bonds.
Okay, thank you. So I guess the last observation, we take that as a compliment and we take it as a fact that we are offering a very nice, attractive risk-reward ratio for our investors, even being rated B with a stable outlook. Of course, we as a company, and now especially post-IPO, we will be having a discussion with our rating agency. That discussion is expected to happen in the next few months. Actually, by end of June, we should have our annual rating reassessment cycle finished. So of course, we'll be having an in-depth discussions with the rating agency, and I'm sure we're going to be going through our improved credit profile, and we'll look at all the details and all the post-IPO positive effects to our credit story and the balance sheet. No promises as of this moment from our side as a company. We'll be doing everything for the credit to be improved in the future.
Our next question. What is the bid yield to maturity in the OTC market? For example, on Bloomberg. Do any banks provide quotes or liquidity for this issuance?
Yeah, so I believe the bid-ask yield to maturity, I wouldn't be able to quote from top of my head, but as I mentioned before, the yield to maturity, if you look at the Bloomberg screen, probably is at or below 10%. So our goal with issuing this tap was to price the bond appropriately as it is trading in the secondary market, or even price it slightly below. We don't have a dedicated, let's say, liquidity manager in place. However, if you saw the terms of our bond, you saw quite a substantial number of different banks participating. So you can be sure to expect that these banks will sufficiently service their customers and also from time to time participate in OTC markets. And we have seen them being very active in the currently issued bonds.
Thank you. What are your current highest interest liabilities?
So current, purely from the nominal interest rate perspective, I believe the highest cost for a debt you would find in our African, let's say, markets where we are borrowing in local currency. However, from our perspective, there we need to deduct any potential local currency depreciation. So that's why, as I mentioned before, also we're more than happy to borrow at a higher nominal interest rate, especially in the non-euro markets, because by doing so, we're actually fixing in or minimizing the potential currency exchange rate volatility for our P&L, especially if we look at those markets. If we look at the euro markets, then the highest cost of debt, I believe, we'll be able to find in a Mintos platform. Although in the platform currently we pay somewhere in the range to 10.5% blended. That consists from different loan offerings, starting as low as 6-7% and going as high as 12 or even maybe 13%. And these 12 to 13% loans in the platform, these are the ones that will be looking to refinance in a near term, short term, partially with the bond tap proceeds.
Thank you. Our next question is about the possible repayment usage of the repayment rights. Under what conditions would you exercise early repayment right after 31st of October 2026? As bond offer is at premium, early repayment would impact the real yield for bondholders.
Yeah, sure, and that's a correct observation. Provided we would exercise that call option, the real yield would go down. But I think it's important to highlight that it would not go down in time. So let's say currently we're offering a yield to maturity of 10%. Yield to call or yield to first call, I believe, is somewhat in the range of around 8%. So it's a still very high single-digit yield figure, even if we would exercise the call option. However, if we speak theoretically under the conditions where we would exercise the call option, these would be the usual conditions. So us proactively thinking and let's say using the favorable windows in the capital markets for potential bond refinance. So let's say if we would see that some 2 years or 1.5 years until the bond matures, there's a favorable conditions in the markets, meaning we could expect a substantial demand for our new bond to be issued in the markets. Then we would exercise the call option in those instances. But then again, it would be replaced with a new debt offering. And in most instances, we have always offered our existing bondholders to participate in the new bond offerings.
Thank you, Mari. Who are your biggest competitors in the Baltics?
When we talk about Baltics, here by now biggest competitors are banks, not the traditional Scandinavian banks, but banks which are a bit more flexible, a bit faster, a bit more consumer oriented. So at different segments, they are the biggest competitors for us. We have our own benefits. We in most cases have better sales channels, more widespread ones, but of course banks and faster processes, but banks can offer lower price since they have deposit money.
Thank you. We have 2 more questions to go. Who are the largest holders of your bonds?
Okay, so this information is unfortunately not fully available for us because these are both of these bonds are having, let's say, foreign or non-Baltic ISIN. So this bond is DE ISIN, the other 150 million euro bond XS ISIN. So we do not see the current ownership of these bonds because the bonds after the subscription they could have and most likely have changed hands. However, I can say that we are really proud about a really diverse structure or participants in our bonds. If we compare, let's say, 150 million to this 50 million bond which we're tapping currently, I would say that this 50 million bond is more Baltic slash retail slash private investor driven than the 150 million euro bond, which in turn is actually more invested by larger institutionals, asset managers, private banks, in some instances pension funds as well. So that would be, you can call it indirectly, a more institutionalized bond. At the same time, that bond is also actively trading in the secondary market. And we see that that bond is invested also quite substantially from the retail, especially coming out of Germany.
Thank you. At this moment, the last question from the participants. Are the average interest rates of your products disclosed anywhere?
We do not, let's say, we have disclosed in the bond documentation and the prospectus, we have certain from to levels per product, per market. So I believe in our bond prospectus, you should be able to find that information. As it relates to the presentation of financial instruments, we disclose the blended, the return on our loan portfolio. But specific market per market, product per product, you should be able to find those details in the bond prospectus.
Thank you. We have addressed all questions. Before we're closing the call, Modestas, Mari, over to you for the final remarks.
Thank you very much. So once again, I wanted to thank everyone for showing interest in the company, in our bond offering. And as Maris has already mentioned, our webpage, eleving.com, is the best source for additional information, where you can find all of our financial results, where you can find more detailed explanations how to invest. You can even find a yield calculator and many useful information. So if you're interested in this offering, I suggest you to check out our webpage. And lastly, a reminder that the subscription period ends this Friday, the 7th of March. Typically, banks are already closing investment opportunities. Some of the banks are closing even midday, so be mindful of that. And with that, I guess that's it. Thanks everyone. Thank you, Nasdaq, for arranging this, and have a nice day, everyone.